Hello and welcome to my investment newsletter. Let's get right to it. In 2023, the investment markets ripped higher by about 26%. Then in 2022, the investment markets ripped lower by about 18%. Then in 2021, the investment markets ripped higher again by about 28%. And then in calendar year 2020, or COVID year, the S&P 500 rose about 4% here, and then dropped about 33% from COVID in about 30 to 35 days, and then made all of those losses back and finished higher on the year by about 18%. So let me just pause for a moment there. Did you realize how large of swings we've seen in the S&P 500 in just the past few years? It's no wonder when I talk to clients about investments and investment allocations that their eyes start to roll from all the ups and downs that we've experienced over the last few years. So because of this, I created an investment-focused video to really help unpack some of the markets and review some of the implemented changes to portfolios over the past year, as well as share some of the anticipated changes that we anticipate to see in the market going forward. But before I get into investment specifics, I want to step everyone back and put some perspective in place. Because before any investment is recommended or implemented, we first need to understand one, what you're investing for and why. And this is what Stephen Covey talked about, putting first things first. And then the second item is developing what specific investment allocation is going to align with those ever-changing goals. And then third, and finally, continue to work through a repeatable process of keeping your specific portfolio in line with your long-term goals, as well as keeping in line with the ever-changing markets. Now, if this gets a little too busy or complex, please forgive me. That is not my intent at all. However, this does get tricky pretty quickly. So I'm going to do my best to impact this in meaningful ways. So to reiterate, the first is going to develop the financial goals and then plan to work towards those goals. Then what the investment allocation should be used to work towards achieving those goals. And finally, how do we keep the portfolio relevant and in line with your goals and the ever-changing markets? Yes, I do realize that if you're sitting here watching this, reviewing this, you're probably thinking, wait a minute, I thought this was supposed to be about investment markets, not financial planning, and you're absolutely right. This is about investments. But you have to ask yourself the question, when you invest in the market, are you investing just to grow your money? Or are you investing so you can do something else with your money? I don't work with any clients who just want to grow their money. All the clients I work with want to accomplish something more with their wealth. And this is why we need to keep money and wealth in its place and treat it like a tool. It's something we can act upon and hopefully increase our impact and effectiveness. And this is why in client meetings, why I spend so much time on developing what someone's statement of financial purpose is. And that on the screen, this is just an example of one of these purpose of financial statements that I talk about. And this is regularly reviewed with clients and updated. Because retirement, of course, is just the most common goal. Great, okay? But then what's next? Because after a client or after you can afford to retire on your terms, adjusted for inflation, healthcare, and taxes, what else do you want to accomplish with your wealth? Or who or what do you want to benefit? In that, a common thought exercise that I guide people through is, and this is morbid, but it's common. You've probably heard of it. It's called the eulogy simulation. And really the idea here is to simply envision your funeral. Yes, morbid, I know. But just imagine for a moment that you're at your funeral and it's time for the eulogies. Who do you want to speak on your behalf? What do you want them to say? What impact do you want to leave on the ones who you loved and those who survived you? And that the answers to these questions are typically not as straightforward as creating a retirement projection. And that I think you're starting to get my point on this. Because the better that I, as someone's financial advisor, can understand the client, the client's specific financial goals, the better I'll be able to guide us through what should be the right investment allocation. And that now once we have the financial goals mapped out, or at least in the ballpark, then we can start to create a specific investment allocation that'll be designed to work towards accomplishing your specific goals in a specific period of time based on your specific risk tolerance. And yes, I realize there are a lot of specifics at work. There's no one size fits all, and there's no website, at least none that I have found, that you can file that would give you investment guidance that will just work for you in absence of developing a financial plan. Sorry, I just don't see that life is really that kind. And that, a final word on this is that whatever your financial plan is, and whatever your corresponding investment allocation is that it's likely already wrong. Sorry, it's just the way it is, and that we're all humans. Our goals change at a moment's notice, and likewise, our investment strategies need to change at a moment's notice as well. As such, your financial plan changes with your investment allocation. So this is one of the reasons why I'm such a strong advocate of fully liquid and flexible investment allocations for clients. Okay, so with that said, now let's transition into some of the investment weeds. All right, so when looking at investments, there are four main items here. Diversification, which, yes, this is boring. Being strategic, got it. Research driven, and then how do we actually implement some of these changes that I'm talking about? And that these are the four foundations of investment selection and allocation. Now, if you want to get more information on investment principles I follow, you can always jump over. You can always jump over and look at my blog here, my website, and scroll down, and you can see this January listing, principles and outlook. And here in this blog post, you'll see some of the core investment principles, as well as some economic commentary that was just released last month. Now, switching back though to diversification, because yes, I realize that a lot of times diversification can be boring because so much talk is given to diversification. And the reason why, I'm going to try and back this up and share why this is so important. So here's this chart. There's a lot going on this chart. So let me just take a moment and try and unpack this. What this chart is showing is the comparison of the S&P 500 and then a diversified portfolio. And you can see different sections of time, 2000 to 2002, 2003 to 2007. And you can see what the S&P did versus what the diversified portfolio did. And so, when you look at this first time period, you can see, well, both of these went down. And so the common thought is that I lost money. This next period of time that the diversified portfolio did a little better. And so great, diversification worked. Again, both these went down. You lost money. The S&P went up higher than a diversified portfolio. Got it. So on and so forth. And then we can scroll down here and say, okay, well, how does this all end up? And so when we see how this all ended up over, a 23-year period of time, the common question is, well, why wouldn't I just invest in the S&P 500? If it all seems to be the same, why waste my time with diversification? I understand, right? This is very common. But then, okay, well, let's take a look at another chart here. And on this other chart, what we're seeing is that a much longer period of time than just going back to year 2000. And so what this chart is showing are different swings. So you can see during this segment, international positions outperformed the S&P 500 or U.S. markets. The U.S. outperformed international, international outperformed U.S., U.S. outperformed international, international, U.S., so on and so forth. So on the back and forth. Now, we do not know when these trends are going to shift or change. Okay, but now with this said, all right, well, let's go back and look at this chart before. Because we see here that this only goes back to year 2000. And so something that I want to point out here is, well, the market went down 40%. It went up 82, it went down 37, it went up 351. And let's just look at this one specifically. I was saying, well, the S&P went down 37, diversified portfolio went down 28. The S&P rocketed back 351%. Diversified portfolio went up a lot, 237. Now, where there's a large disconnect here is the actual math here. So if I lost money, how much more do I need to make it back? Because it's not a 1-for-1. If you lost $1, you need to make more than $1 back from a percentage standpoint to break even. So this chart here, I find it to be very, very helpful. I'm saying, okay, well, if I lost 10% in the market, I need to gain 11% to break even. Okay, if I lost 5%, I need to gain 5.3%. If I lost 30%, I need to gain 43% back in the market. Okay, if I lost 50%, I need to gain 100% back in the market. So, when you see this information, it's not one for one, right? And it gets more extreme as it goes. So, you look at this saying, all right, well, only 5% down, 5.3 up, right? This one is, I lost 50, I need to double that to get 100%. I lost 70, I need to make 233%, all right? So the math here is, yeah, we also want to protect on some of the downside as well. And so when I go back and look at this the diversification chart, again, what I want to point out is on the downs, right, the S&P went down 40, diversified went down 15, 37, 28, 30, 24, 18, 15. In each of these occurrences, and yes, I realize this is a short amount of time, but the downside looked to be less, right, than just the overall S&P 500, which is one of the benefits and one of the mathematical benefits of adding to diversification, all right? Now, the second item that I want to look at is going to be strategic, okay? So the first one, diversification, the next being strategic. And when looking at strategic, really to me, this is the most obvious one, because unless you have a crystal ball, and I realize that you don't and I don't, is that none of us know what the future holds. There are no data points. There are no facts about the future. And the reality is that if there was a person or firm who did know the future, then 100% of all my investment dollars and 100% of all your investment dollars would be invested with that person or firm. It just isn't the case. And so because of this, I've learned to embrace my limitations and ignorance with investing. So to help create strategic portfolios, I utilize research from some of the largest money managers in the world. And that the end effect is that our portfolios have very similar structure as some of the most wealthy investors in history. And that in today's environment, I'd argue that there's likely no larger driver of markets. Get myself out of the way. I'd argue that in today's environment, there's no larger driver of market than interest rate policy of the Federal Reserve in the United States. And that as interest rates move, so do market returns, or at least historically. And that in this chart, we see where the Fed has been and where the Fed rates are anticipated to be. Of course, anticipated. We don't know. These anticipated moves by the Fed are what's driving some of the investment allocation changes, which goes into some of the research-driven changes that were implemented in January 2024. And that in January 2024, there was a very normal investment reallocation. And this reallocation was designed to execute on 3 items. And so you can see here, this is a very, very, very busy chart. But let me just try and unpack some of the 3 main items. One is a slight overweight to U.S. stocks in trying to reduce overall active risk. And that the idea here is that the market has surged higher over the past few months. And it'd be surprising if the market, and it wouldn't be surprising if the market pulled back. Okay, just normally what happens. Market surges higher, market pulls back a little bit. Great, consolidates is the typical inside baseball term. And that should this happen, this slight overweight to U.S. stocks may help prevent some of the downside. Now, keep in mind, when I say slight, I mean slight. This is not an allocation change that's going to fundamentally change the portfolio as a whole. Another item is added a new position in an ETF that's designed to follow the U.S. equity market, and it's flexible enough to be able to move between growth and value sectors, and that the ticker symbol is DYNF. And that 2023 was a year of high concentration and narrow stock breadth. And so, what I want you to think about, and the example here is that in 2023, there were just a handful of technology stocks that carried the rest of the market. And that this ETF is designed to help navigate these waters. And then the third item here is taking some of the gains from growth style investments and moving those over to value style investments. You can see this new fund here, this DYNF, listed up here. And then speaking specifically on the value and growth, you can see this increase in allocation in this S&P 500 value. Okay, just some of the specifics that I'm talking about there. Now, when looking at implementation, there are 2 areas to address. One's going to be investment allocation, and the other is rebalancing that we're going to look at. So firstly, on the reallocation of funds, again, this is going to be based on research, and it happens about 4 times a year. And so what you can see on your screen right now is on the back-end investment analysis software I work with. It's by a group called Quanti. And you can see how on this chart, it happens about 4 times a year is when a specific fund or funds are subbed out for others, really in an effort to help keep the portfolio in line with the current economy. And on this chart, I want to see just over the past year, this line here, there's a rebalance happened in March 16th, 2023. Another rebalance here in July. Another rebalance here in October. And then this one that just happened at the end of January. And that, the next item of the regular reinvestment and small rebalancing along the way. So it does you no favors to simply implement an investment allocation and then to never adjust to it over the years. And also does you no favors to implement that allocation, but not have the discipline to keep it balanced throughout the year. And so because of this, I've developed a weekly process for my clients where I review client portfolios that I manage, and it alerts me of any potential investments that can or should be made. And what this results in is a constant fine-tuning of client portfolios. If you're a client and you want proof of this, what I'd encourage you to do is look at your transaction summary on any of your investment statements, and you're going to see some of these very small trades happen throughout each of the months. Now, on a side note, is that in years past, these small trades did not make sense. They were not practical to do. Okay, and the reason for that is that there used to be trade fees every time the portfolio was touched. Well, thankfully, that's no longer the case. And the funds that we use do not have a trade fee attached to them. So what does this mean for end clients? It means that your portfolio can be traded without incurring any additional trade fees. Typically, this is going to result in better returns for you. But now I want to turn back to portfolio structure again, and how this is research-driven, strategic, and diversified. But, and on your screen, again, you can see how over the past year, there have been these 4 different rebalances, all focused on diversification, strategic, research-driven, and then now it's implemented. Now, but the last thing I want to do is see, okay, how does this compare to other similar portfolios? And so what I'm going to look at are similar portfolios from BlackRock, State Street, and Wilshire. And when I share this information, this is by no means, at all, please, this is by no means to say that the portfolio managed will constantly outperform, but I certainly do have confidence in the process that's being followed. So let me just show you this information. So all this is looking at, and again, I realize this is a short period of time, but I do think this is helpful and important and material in nature to share. So when looking at the all equity portfolio that I help run and manage for clients, you can see the return over the past year is 20.4%. This is the BlackRock allocation and all equity allocation. This is an allocation generated by State Street, and this is one generated by Wilshire. And so, as you can see over here, the differing in investment returns, how they stack up. These two are very similar. These two are not. Again, I do not see this as saying, look, we're always going to outperform. But it is nice to be able to have a proof point of, yes, this is the process being followed, and yes, there is a strong basis of information to say, yeah, the process continually works. Okay, so in closing, please hear me that when I say the most important part of your investment allocation is getting your financial plan on the right track, and then having your investment allocation aligned with your long-term financial plan. And that if you're watching this and you're not confident, okay, if you're watching this and you're not confident that your investment allocation is right for you, please do yourself a favor and tell me so we can have a conversation around your financial plan and if your allocations or how your allocations need to change to align with your overall financial plan. As always, thanks for your trust. Let me know of any questions. Thanks.